Hello, my name is Chris Shea. I'm a financial advisor with BPS Financial Services, and we're going to go over this presentation today on loan to own. What does that mean? What do you know or want to know about installment loans? We're going to go over the agenda, the ground rules. Well, we'll go over that now. It's pretty simple. If you got a question, ask it to me via email, click on the button, get back to me, let me know what you think. I'm going to introduce myself as well. Objectives. Can identify various types of installment loans. Identify the factors used to make home loan decisions. Talk about laws that protect you when you're applying for a loan. Identify questions to ask when you're buying a car. Explain why installment loans cost less than rent-to-own services. And why it's wary to be important of rent-to-own, payday loans, refund anticipation loans, and go over predatory lending practices, because that's important to you to stay safe. Again, my name is Chris Shea, financial advisor with BPS Financial Services. I'm a retirement and investment partner with my clients and a planning partner with them as well. Help them develop a plan, implement the plan, and stay on track. So let's dig into it. What is an installment loan? At its core, it's a loan that's repaid in equal monthly payments installments for a specified period of time. 5 years, 10 years, 20 years, 30 years, 1 year. Installment loans. What items can be purchased on installment loans? A house, fridge, furniture, cars, computers. Pretty much anything can be purchased on an installment loan, as long as you can agree to the terms. What are secured student loan and secured installment loans? These are loans that are backed by collateral. We'll get into collateral in a minute. They usually have lower interest rates than unsecured loans simply because there is that collateral. There's something behind it that says, if I don't pay this, you get the item. Mortgage, home equity loans, car loans. And these are things that require collateral and are items that can be secured installment loans. So what is collateral? Security or asset you pledge to the lender. If you don't repay the loan, they'll take your or keep your stuff in place of the loan. However, if you do have your failure to repay, then the stuff is kept. If it's not enough to cover the loan, you're still going to have balance, fees, interest associated with it. So make sure your collateral covers the loan. Unsecured installment loans. These have usually tougher underwriting standards than secured loans. Hard to believe in some cases, but there's nothing there to back the company in case you don't pay it. So they also usually have higher interest rates. These are personal loans and private student loans, not the government loans, but private student loans. Now we're going to get into some definitions. You've got 4 things here with definitions, and your choices are going to be APR, fixed rate loan, finance charge, variable rate loan. So we're going to go through it, talk about the 4 things. I'm going to give you the answers. I know, I'm a nice guy. Dollar amount, including the loan will cost, including interest, service charges, and loan fees. That's going to be the finance charges. It's important to find out what your finance charges are at the very beginning to know exactly what you're going to be getting yourself into. Next, a loan with an interest rate that might change during any period of the loan. It's variable rate loan. You got it right. Again, it's going to change. It's going to fluctuate based upon some metric that they use as a standardization. So when that goes up, your rate goes up. When it goes down, your rate goes down. Got to be careful of those. Cost of borrowing money on a yearly basis. It's your annual percentage rate or your APR. And then loan with interest rate that might stay the same throughout the term of the loan. Well, that's going to be your fixed rate loan. Again, know these costs figure out which one works for you, given your circumstances, and choose the loan that's best for you. All right. Now we're going to look at a couple of examples. Stephanie took out a car loan with 10% interest rate, paid 100% in loan application fees. What lending term reflects the interest plus the application fee? APR. Okay. That's a total annual percentage rate. Interest plus the application fee. You got to factor that in. Okay. Michael took out a loan on a computer. You must make equal 24 payments over 2 years at 10% interest. Which lending term best describes this type of loan? Equal 24 months, fixed rate. Right? Kevin took out a car loan. $3,000 in interest, service charge, and loan fees. Well, lending terms best describe these costs. Finance charges, variable rate loan. Why do borrowers prefer installment loans? Okay, why do we as consumers want an installment loan? Clearly states out the payment amount and the repayment period. They're lower rates than credit cards, right? So if you put something on a credit card or a loan, you want the installment loan. And the lower loan balances during loan principal, because the payment includes a principal. So you're going to pay less in interest and you're going to pay less on a monthly basis because you're taking an installment loan instead of using a credit card. Now, the big question is, what happens when I'm going to buy a car? Should you buy a new or used car? Lease or buy a car? How much can you afford? Should you trade in your old car? These are questions you got to look at and ask yourself before you go out car shopping. Okay. Car loans versus car leases. Ownership potential. At the end of the car loan, you own it. At the end of the lease, you got to figure out if you want to buy it and continue paying for it or get another car. Wear and tear on the car. Are you going to drive it a lot or not a lot? Monthly payments. Can you afford the monthly payment for the car, or do you need to get something cheaper? Mileage limitations. A lot of times on a lease, you're going to have very low mileage limitations. If you go over that, it's going to get really costly. So if you drive a lot, that's going to be a big consideration. Auto insurance. How much is it going to cost? Even if you have the better car, quote unquote, at a cheaper rate on a lease, is your auto insurance cost going to outweigh the difference in the cost of owning a less expensive car? I don't know. You got to do that research. And what's the overall cost? Gas mileage as well. With gas prices going up and down, you got to factor that into your consideration. Things that you want to ask yourself. When you finance a car, the car is the collateral for the loan. The title indicates who owns the car. So until you pay it off, it's owned by the car company. Once you pay it off, they transfer title to whomever owns the car now. When considering a car loan, know the costs, how much you need to borrow, and shop around for the best deal. Look on car apps. Find cheap cars out there. Don't buy the car that you find first. Shop around. It's your money. It's going to be your car for 3, 4, 5, 10, 20 years. Get a car that you want. You want to ask a lot of questions. You want to price out low rate financing. You want to find the advantage of paying with cash / using your own financing. What's the down payment required? Are there limits on the length of the loan? Sometimes you get a longer loan, lower payments, might pay more in interest, but it might work out for you. Find out if there's a balloon payment due at the end of the loan. Ask these questions because it's going to help you make a better choice for yourself. Special promotions. Hear them all the time on the radio. I know I do driving around. Special promotion, trade-in allowance, limits on special offers. And what exactly does a dealer's invoice mean? Find out what it is. Ask the dealership. They've got to tell you. Look at service contracts, right? Find out exactly what's covered in them, because it's going to pay for certain services and repairs. Not everything is covered in an auto service contract. Ask a lot of questions before buying the auto service contract. Make sure you know what you're getting. You're in control. You have the power. If there's a lot of things on there that you think you can do yourself or have somebody that can do it cheaper, you don't have to get the insurance. Do it yourself. Used car. Ask about any warranty protection, right? Look at the buyer's guide sticker to indicate whether the vehicle is sold with a warranty, as is, implied warranties. Know what you're getting. Alternative fuel vehicles, becoming much more popular now. Find out the fuel type and the availability, right? You don't want to be getting a car if you live in a very rural area that requires alternative fuel that you have a trouble getting. Find out where you can actually get that fuel and make sure that it's easily accessible for you. Find out what the overall operating costs are. Performance, convenience, again, energy security, renewability, and find out what the emissions are. Beware of dealer-lender relationships, okay? Read the scenario, it's in the activity guide. Read it, write down things that should have been done by Sam. And then if you want, you can reach out to me, discuss them, or talk to somebody else. So you get better informed and get a couple of perspectives on what was done and what might be able to be done better. Structuring a loan payment. Structure matters, okay? Sometimes paying more in interest over the long term is better for you because you can afford it more in your monthly budget, or you've got the room in your monthly budget and you want to pay less, right? So here's the cost of the loan. Say a $15,000 loan, 4% interest for 36 months is $443 a month. Grand total of $15,948. Okay, 48 months is $339 a month, $16,272. For that extra year, you pay extra $300, but you save $100 a month. Which one's worth it for you? Okay. That's up to you. That's your choice. That's your decision based upon your budget and what your finances are. Be cautious of taking out loans for 5 years or more on cars, because then the car might not be what you want in 5 years, might not be what you need. So beware of that. Beware of car title loans. All right. If someone asks for a car title loan, they can be more costly than whatever money you're getting out there. You can lose your car if you can't pay it, right? And we'll go through a little number here. $500 loan with 100% interest, 20%, that's $600. First year, $500 loan, $1,200 in interest, that's 240% APR. I think you can do better elsewhere. So again, beware of car title loans, unless you know that you got the money coming in, you're gonna be able to pay it right back off right away. Equity, talked about a lot, especially with home value prices going up and down, up and down. Your equities, how much you have in your house, which is the value of the home minus the debt. In this case, the example is you got a $250,000 house, $180,000 in debt, $70,000 in equity. Home equity means you can borrow against that $70,000 and the value of your home. How home equity loans work: appraised value is $250,000. Lender's maximum loan to value ratio is 80%, which means most you can take out is $200,000 against your house. 200,000 minus 180, which is the existing mortgage, you can get a $20,000 home equity loan. Do you need it? Do you want it? Will it help you? Again, you've got to assess that to see if it works for you. One-time loan for a lump sum, typically at a fixed rate. There's also home equity lines of credit, which kind of work like a credit card. Interest rates are typically variable and they go up and down and have minimal monthly payments. Again, but they are charged against your home equity. You don't take the money out unless you actually need it. So it's a little bit more flexible. Could be what you're in the market for. Borrowing against your home. Advantage of a home equity loan, lower interest rate usually. Can be tax deductible depending upon what you're doing. Government's made it a little bit tougher for the tax deductible on the interest rate. What's the danger? Lose your home. You could, if the market goes down, owe more than your home is worth. All right. You have 3 days to reconsider signing a home equity agreement and cancel a loan without penalty when you use your primary home as collateral. So again, lots to think about. Talk to someone, figure out what's in your best interest to borrow against your home. Is the line of credit right for you? Can you afford the increased monthly payments after the introductory period ends or when the interest rates rise? That's a very important question you got to ask yourself. Are you comfortable with a fluctuating mortgage payment? Will you be investing in home equity or another asset, paying off debt on higher interest credit cards? What are you going to do with the money? Don't just take it out to spend it on a vacation. Figure out what exactly you want to spend it on before you take the loan out. Unsecured installment loans. These can be used for a variety of personal expenses. No collateral is required, 1 to 5 years, fast approval times, low interest rates and credit cards. However, they're high interest rates and stricter credit requirements than a home mortgage loan or home equity loan. So it kind of fits in the middle there. They can be good for certain circumstances, not so good for others. Again, depends upon where you're at and what you're looking to do. Refund anticipation loans. You're expecting $1,500 back. They charge you $300. You're going to get $1,200 today. Is that good for you? Could be, could not be. That's a pretty high interest rate. If you do have money questions and challenges, borrow from yourself first. We talk all the time when we talk about setting up your foundation for your financials, have an emergency savings account. We recommend 3 to 6 months usually, but I say at least $10,000. Get that built up so that when you do have a challenge that arises, you can take care of it with your cash as opposed to using a credit card. People that have an emergency fund usually wind up in a better financial place than those that don't. Comparison shop. If you're going to borrow money, look at the total dollar cost and the APR, right? $75 interest on a $500 loan for 2 weeks is a $391 APR, 391% APR, excuse me. If you pay $75 to renew or roll over the loan, you owe more in fees in 14 weeks than the original loan. Don't get caught in these circumstances. It can wind up putting you in a really bad spot really quickly. Utilize other avenues as opposed to a short-term high interest loan. Emergency options for cash. Talk to your financial institutions about loan options. Some banks will give you a loan because you've been a member for a while that will help you out, a line of credit. But more importantly, build a savings fund. Again, $10,000 is what I recommend for the minimum. 3 to 6 months of bills is what is more optimal. Credit. There's 4 C's: capacity, capital, character, collateral. Capacity. Do you have the ability to make your payments? Do you have more money coming in than you got going out? Can you make the payments? That's capacity. Capital. Value of your assets and net worth. Do you own a home, a car, money in the bank, retirement accounts? What's your capital? Character. So it's not how funny you are. It's have you paid your bills in the past? Do you have a good record or a not so good record. And collateral, property assets used to secure the loan. 4 C's of credit. Consumer protection laws. There are a lot of them because there are people out there that will prey upon people in hard times and take advantage of them financially. There's the Equal Credit Opportunity Act, Truth in Lending Act, Fair Credit Reporting Act, Fair Credit Billing Act, Fair Debt Collection Practices Act. Lots of attempts to make it fair, but remember, you got to know the laws, find out, get educated. If you're having credit problems, look these up, get yourself some education. How lending laws protect you. In the participation guide, there's a scenario. You can answer the questions. If you want to have a conversation about it, feel free to reach out or talk to somebody else and get a different perspective. If you've got complaints, well, there's the FDIC, Federal Deposit Insurance Corporation. State the problem, including the information. Copies of documents. Big word in there is copies of documents that can help you explain your problem. Keep your originals. They're yours. Give them copies. Sign and date your letter. In another presentation we do on credit, we give you some examples of letters. There's more consumer protection laws. There's a Fair Housing Act, Service Members Civil Relief Act, Real Estate Settlement Procedures Act, Consumer Lending Act. Essentially, there's a lot of laws out there to protect you, the consumer. Know what they are. If you're in trouble, find out. Predatory lending practices. Yeah, the shark, the loan shark. These include marketing tactics, abusive collection practices, loan terms that deceive and exploit you. Occurs in mortgages, home equity, credit, auto loading, payday lending markets. It occurs in every avenue of loaning money. Beware. Read all the details. If you've got questions, go get a second opinion. Talk to someone who's in the business in some other area. See if they agree or disagree. Maybe get a third or fourth opinion. Shop around. Protect yourself. Don't become prey to the predators. Subprime lending. This involves extending credit to borrowers with a poor credit history. There's subprime borrowers that could be predatory loans. Not all of them are, but the interest rates on the loan may be higher to offset the higher costs associated with the risk taken. Beware of subprime lending. It can be challenging to you. Predatory payday loans, small cash advances minus the fees. Right? Pay $230 out of your check. You're going to get $200. The lender fees is $30. That's a $390 annual percentage rate. That's huge. APR for a mortgage, 3, 5, 7%. Credit cards, even high credit cards at 25 APR. This is 390%. Look at different ways, aside from payday loans, to get your money. Predatory mortgage lending practices, excessive fees, abusive repayment penalties, kickback to brokers, yield spread premiums, loan flipping, unnecessary products thrown in there, asset-based lending, steering, targeting to consumers. Be on the lookout. Talk to multiple mortgage lenders. Don't become prey to the predators. We'll try and help you out here in the participation guide. Read the scenario in example 3, answer the questions. Again, you can talk about them if you want, or again, find someone that you know and you want to have a conversation with. Hopefully, this is giving you the basics on understanding loan terms, how they work, and the impact it can have on you. Hopefully, you've learned a good amount. You're able to know a little bit more. You're probably going to have some more questions, so feel free to ask about your specific circumstances. And if you want, I'd love to hear from you about evaluating this training. In conclusion, hopefully you've learned a little bit about secured and unsecured loans, cost of loans, APR, variable, fixed, car loans and auto financing, a little bit about home equity loans, 4Cs of loan decisions, and we've exposed you to some of the predatory lending practices and shown you ways to protect yourself. So hopefully this has been an education that you've enjoyed. Again, my name is Chris Shea with BPS Financial Services. Any questions, feel free to reach out.